Recording.
Yes, yes. Uh, good evening, all the members of Matunga CP Study Circle, and welcome you to the evening session of today's virtual CP meeting. And it's my pleasure to introduce the Mr. Vyomesh Pathak ji, who will be taking us through the topic of the day, which is recent changes in the tax audit report. And Vyomesh Pathak ji is an associate director with corporate and international tax team of BSR and Company. He has more than 11 years of professional experience serving large-scale infrastructure, real estate and construction, hospitality, tourism, healthcare, manufacturing, IT/ITES, telecom, media and entertainment, PE funds and infrastructure funds, and services sector clients. He has significant professional experience of working with Big Four consulting firm in India. He is serving major multinationals and Indian corporate clients in the areas of corporate tax, cross-border taxation, cross-border investment and business structuring, exchange control regulations, regulatory aspects, mergers and business reorganizations. Coming to the industry contributions, he is currently the Vice Chairman of the Law and Representation Committee, as well as a committee member of Research and Publication Committee of the Chamber of Tax Consultants, CTC. He's been a co-author for the book on ICDS, which is released by the CTC in the month of June 2017. He's a regular contributor to the WIRC referencer of ICI from 2016-17 onwards. He has been one of the youngest member on the vetting panel. Also, he is a regular contributor to the WIRC newsletter. He's also a regular contributor for various articles for the CTC, ICI, Tax Sutra, AIFTP, and various other news tax news alerts. He's a regular speaker and faculty at KPMG Tax Academy on the topics of international tax and FEMA. He is a regular speaker and he has delivered more than 250 sessions till date. I think he's a seasoned player, and we look forward to Vyomesh ji to today's session and his expertise on the topic, which is recent changes in tax audit report. And with this, Vyomesh ji, I hand over the proceedings to you, and we wait to attentively listen to your session.
Yeah, thank you, Anuj. I'll just share my screen.
Sure, sir.
Yeah, so is my screen visible?
Yes, sir.
Yeah, thank you. So at the outset, let me thank Jiten Bhai, Rajendra Bhai and Anuj for inviting me to Matunga CP Study Circle. I think this is the first time we are interacting at Matunga Study Circle. And the topic for today's discussion is recent amendments and recent developments in tax audit report. Now, if I'm just looking at the members, and thanks to the ICI protocol that we also need to mention our membership number in the name while entering the meeting. So I see many senior chartered accountants here. So while I was addressed as a seasoned player, I don't think I am a seasoned player. I am very young as compared to the seniors present out here. So the agenda for today's discussion is not, obviously I'll be sharing my views, my thoughts, but I also want it to be an interactive one. And maybe we can interact on the chat box, and towards the end we have the Q&A. We'll keep 15 odd minutes for the Q&A, so that it can be a dialogue and not just a monologue, so that all the members can interact and share their views. Because tax is a topic wherein interpretations are bound to happen. So therefore it is always different thoughts are always welcome, and it is not about right or wrong. It is about how do we interpret a particular law or a particular provision for that matter. So coming to the subject proper of recent amendments in tax audit, which we are supposed to deal with, the way I have structured this slide deck or the presentation is basically we begin with the context, that is the applicability, because that is where there is one change coming this year, and there are a lot of deliberations, discussions going on in terms of whether tax audit will be applicable in particular case A, case B, case C, and we have our own WhatsApp university going on with different interpretations on it will be applicable, not applicable, everybody having their own views and own thoughts. So we begin with that, and then we move to the changes to the tax audit report, the recent ones which have been specifically included with respect to the concessional tax regime under the Income Tax Act, and then we move on to the other changes. I have tried to cover the changes as early as couple of years back, so that the reason is I see many tax audit reports wherein though the changes are there in the form, but I see simply reporting in the form of not applicable, which may not be true in all cases. So therefore, I thought I'll take up the changes which were there earlier also, and then the changes which were introduced from 2018. And towards the end, I'll also cover the tax audit report changes in respect to ICDS. So that is how I plan to structure this particular session, and then towards the end, obviously, we move to the Q&As and interactions with the members. So moving on to the first aspect and the applicability. Now, till last year, the limit was 1 crore for business other than 44AD, that is assessment year 1920. Uh, so I have broken up the applicability slide into two parts. One is the business, and another one is profession, of course. Within business, we have two subcategories, that is 44AD and non 44AD. So for non 44AD, the limit or the applicability is the threshold is 1 crore till assessment year 1920. For 44AD cases, the tax rate is applicable only if profit offered to tax is less than 8% or 6%. 44 ADA, that is the professionals opting for the presumptive taxation. The limit, not opting for presumptive taxation, the limit is 50 lakhs. And if you are opting for presumptive taxation, then if your profit is less than 50%, then the tax audit becomes applicable in your case. Now coming to this particular year itself, I am restricting this slide to AY 1920, and then we speak to AY 2021 onwards and what changes from this year. So as far as business turnover between 1 crore to 2 crore is concerned, the tax audit will be applicable generally unless I have opted for presumptive taxation. So effectively, if I have opted for presumptive taxation and say for example my turnover is 1 crore 50 lakhs, then in case of 1 crore 50 lakh turnover, if I have opted for 44 AD, then the tax audit will not be applicable to me unless the profit percentage is less than 8% or 6%, as the case may be. However, if I am not under presumptive taxation and my turnover increases by from 1 crore or in this case say 1.5 crores, then for a turnover of 1.5 crores, 3CD or tax audit will be applicable to me for this year. Now what changes in this year, that is assessment year 2021? Only one change, rest all three baskets remain the same. The only change is in the first basket here, wherein we have the turnover limit increased from 1 crore to 5 crore. Limit being increased from 1 crore to 5 crore with a condition that if all the receipts for sales, turnover, or gross receipts during the previous year in cash does not exceed 5% of the said amount, 5% of the said amount, and also the aggregate payments does not exceed 5% of the total payments. So effectively, it is like my cash receipts should not exceed 5%, should not exceed 5% of the total receipts. At the same time, my cash payments should not exceed 5% of the total payments. So receipts should not exceed 5% in cash. At the same time, payments also in cash should not exceed 5% of the total payments. If I satisfy this criteria, then my limit increases to 5 crores. For other cases, assuming my cash receipts is more than 5% or my cash payment is more than 5%, either or, then my limit remains as 1 crore. In that case, my limit remains as 1 crore. So that is the change applicable from this year, that is assessment year 2020 onwards. The limit has been increased to 5 crores subject to the limitation or restriction on cash receipts and cash payments. Now, one thing I would like to clear or clarify or share my views on is Applicability of 44AD. Now, since the limit has been increased and various discussions going around, I have been receiving many queries in respect of whether 44AD is mandatory or is it optional. So my view on this particular aspect is 44AD is a beneficial provision, one, and therefore it cannot be imposed upon a particular assessee. It cannot be enforced upon an assessee forcefully. It is always optional. Any benefit given under the act will always be an option to the assessee. In this case, if the assessee doesn't want to go for 44AD, he can very well opt out of 44AD and he can fall under the normal provisions of the act. Uh, Another aspect is, if you look at subsection 5 of 44AD also says that if once you have opted out of 44AD, then you cannot come back to 44AD for a period of 5 years. So effectively you are debarred from 5 years. So this provision also supports this view that 44AD is optional and it is not mandatory to the assessee. Now, another interesting aspect here is, assuming my turnover is say 2 crores. Assuming my turnover is 2 crores, so therefore I am eligible for 44AD. So if I am eligible for 44AD and I opt for 44AD, I need to have profit of at least 8% if I don't have, if I have not received through the normal banking channels, or if I have received the payments through the normal banking channels, then the profit percentage is 6%. So assuming my turnover is exactly 2 crores, assuming my turnover is exactly 2 crores, so therefore I am liable to tax audit if my profit is say less than 8% or 6% as the case may be. Now, if I increase my turnover by 1 rupee, if I increase my turnover by 1 rupee, so effectively my turnover is 2 crore 1. Effectively now my turnover is 2 crore 1. So effectively, since I have crossed the 2 crore limit, 44AD is not applicable to me, right? 44AD is not applicable to me. And if my receipts and payment is also, cash payments and cash receipt is also less than the total receipts and total payments, in that case what will happen is I can very well offer the profits which is less than 8% or less than 6%, and tax audit also will not be applicable to me. I repeat, tax audit will not be applicable to me because I am out of 44AD now. My turnover has crossed 2 crores. Secondly, for applicability of tax audit for non 44AD cases, now the turnover limit is 5 crores, right? So this is, I won't say a lacuna in the law or a loophole, but this is how the law is currently, that if you are if you are opting for 44AD up to 2 crores, so if you have a turnover of exactly 2 crores, you have to show the profit of 8% or 6% in order to overcome the tax audit. However, if my turnover crosses 2 crores, then I may also offer a profit which is less than 8% or 6%, and I will also get away with the tax audit. So this is the law as on today, considering all the aspects and all the provisions as it stand today. We never know if the government intends to change this particular position later on going forward, but this is how it is as on today. Coming to the forms, again brushing up our basics. Form 3CA is applicable in case of person carrying on business or profession whose accounts are required to be audited under any other law. A simple example can be audit under the Companies Act. In that case, Form 3CA is applicable. Form 3CB to person other than those referred to in Form 3CA. At the same time, if my accounts are required to be audited under any other law, but its accounting year is different from the financial year. For example, we have many corporates, many multinationals who follow the calendar year as their financial year, who do not have their accounting year as the financial year, that is March ending. There are many multinationals who have 31st December as their year end. So in that cases, you will use Form 3CB and not Form 3CA. Moving on, what happens if I fail to get the tax audit done? The implication is, you all know better, 271B penalty. which is as high as 1,50,000 or 0.5% of the turnover, maximum penalty of 1,50,000. However, we have section 273B, which says that no penalty will be levied if there is a reasonable cause. Now, reasonable cause is something which is not defined under the Act, but a few examples of reasonable cause I've just tried to capture it in this particular slide itself. That is natural calamity, fire, theft, non-availability of account due to seizure, death, or physical, I would say, disability of the partner, etc., or bona fide interpretation of turnover based on expert opinion. So these are the few examples. Now we are currently in an exact situation wherein we have just started, few of us have just started going to offices, few of our clients have just started going to offices, but many of us are still working from home, and most of our clients are also still working from home. So can you say this pandemic situation also as a reasonable cause? Or do you see that this will be a reasonable cause because the reason is we were not able to complete our accounts, we were not able to finalize our accounts, and thereby get the same audited? Arguably, yes, you can still say that. Having said this, the due dates have already been extended. So therefore, considering the extension, of the due dates, we still have enough time to complete the tax audit in the months to come, and thereby submit the tax audit report and also the income tax returns as and when we are able to finish those. So this is about the failure to get tax audit done. Now, another important aspect is in relation to us, that is the tax auditors who are signing the tax audit report or 3CD. There is a recent penal provision introduced with effect from 1st of April 2017, that is section 271J, and penalty for furnishing incorrect information. And in this case, the penalty levied is on the tax auditor or the chartered accountant furnishing the report, and the penalty is 10,000 rupees. Now, it is not just about the penalty, but what is relevant here is that the current situation which we are in, we need to be mindful of the fact that chartered accountants or the auditors are always the soft targets of the governments and the regulatory authorities. So therefore, penalty is one aspect, that is 271J. If anything wrong happens in the market, be it the securities market or be it the corporate frauds, etc., then the first soft target is the auditor of the company, the chartered accountant of the particular client, etc. So therefore, as I said, that we have to be more responsible going forward, not just for the clients. While we have been responsible for the clients, I must say that we are not responsible towards our own self, that in terms of documentation. While we do the audits, we do everything properly and complete the task on time. Where we lack is the documentation or the audit trail. So that once we have the documentation or the audit trail, ultimately we can prove to the authorities that we have done our bit and we have documented all the evidences or the audit working papers, so that we have done our bit and to the best of our abilities. That will support or that will help our ourselves to safeguard our own interest. So therefore, this is very, very important. Penalty is one aspect. We need to look at the larger picture and safeguard our own image and safeguard our own interest. Moving on to the changes in the tax audit report in relation to, as I said, recently the new tax regime has been applicable from this year onwards. So therefore, there is a change in the tax audit report form also. 3 changes. Before going on to those changes, let us first understand what is the new tax regime in a nutshell and what is this concessional tax regime. Of course, I'll not go much into detail of it, but we'll just cover up or touch upon the aspect of concessional tax regime. What is the tax rate and what is the admissibility, etc. So if you look at this particular slide, I have tried to summarize in a nutshell the new tax regime. So earlier, if you are aware, there is one section which is introduced with effect from assessment year 17-18, that is section 115BA for domestic companies engaging in manufacturing or production. and setting up and registered on or after 1st of March 2016. The reduced tax rate for them was, or it is still there, 25%. Surcharge is 7%, 12% as the case may be. And the MAT is applicable at 15%. Other domestic companies also, the rate was 25% and 30% respectively. 25% for the assessees whose turnover is up to 400 crores. That was the threshold. Now, if you look at the concessional tax regime, assessment year 2021 onwards, that is the year for which we will be filing the tax audit reports this year. The start date is again the same year, AY 2021. You are not allowed any prescribed deduction, loss, etc. For example, you are not allowed accelerated depreciation, you are not allowed Chapter 6A deduction, except ATG for this year and ATJJAA, and you are not allowed any weighted deductions, etc. For if you satisfy these conditions, then your basic tax rate will be reduced to 22%, and after including surcharge and cess, the effective tax rate comes to 25.17%. Another important aspect is that MAT also will not be applicable to the assessees opting for 115BAA, so will be out of MAT. Another change or another amendment is 115BAB in relation to the manufacturing companies. In order to promote the Make in India campaign of the government of India, they have introduced this reduced tax rate for new manufacturing companies set up after 1st of October 2019 and commencing of manufacture by 31st of March 2023. There is a reduced tax rate of 15%, surcharge of 10% and cess of 4%, and MAT will not be applicable in this case also. So these two are the new concessional tax regime which are applicable from this year, and many corporates who do not have substantial Chapter 6A deductions, who do not have any weighted deductions, they have actually opted for 115BAA, and new manufacturing companies have opted for 115BAB also. So in relation to this new tax regime, the tax audit forms have been updated. There are three changes, as I said. The first change is insertion of clause 8A, which says that there is an option for section 115BA, BAA and BAB. Whether the assessee has opted for taxation under any of these sections, that is BA, BAA and BAB, you just need to reply yes or no in this particular clause. Then if the answer to this is yes, there are subsequent two changes in clause 18 and in clause 32 later on. So 18 CA and CB have been inserted with respect to the WDV due to the section 115 BAA. Adjustments made to written down value under section 115 BAA for assessment year 2021 only. So this is only for the transition period, because if you have any balance of unabsorbed depreciation, or if you have any additional depreciation to be claimed, then that will not be allowed in the new tax regime, and therefore you have to make an adjustment to the written down value. And CB is ultimately the adjusted written down value as per clause 18 CB. So this is the change in my depreciation schedule, tax depreciation schedule as per clause 18. Next change, as I said, is in clause 32, which is in relation to the carry forward of loss amended for section 115 BAA. So if you look at clause 32A, two columns have been inserted, column 5 and column 6. So column 5 says all losses or allowances not allowed under section 115 BAA, and 6 is again a transition year adjustment, that is amount adjusted by withdrawal of additional depreciation on account of option or on account of opting for taxation under section 115 BAA. So this is the change with respect to the new tax regime or the concessional tax regime. Three changes to Form 3CD this year. Now we move to the other changes in the tax audit report. As I said, I have tried to capture 2 years, that is last to last year as well as last year, in terms of the changes in tax audit form, so that we can refresh our memories and we can ensure that we are not missing out on anything in terms of the new reporting requirements. So summary of changes, this was there last to last year. Clause 13. Now, as most of you might be aware that ICDS is applicable from assessment year 17-18, and the method of accounting is now, it has to be with respect to ICDS, and therefore three clauses are inserted: 13D, 13E and 13F. We'll discuss these three clauses in detail in the subsequent slides. Other changes in respect of manner of accepting and repayment of loans and advances, that is 269 SS and 269 T, which is relevant here. Again, we will go into the details of these two clauses in the subsequent slides. So this is for clause 13, and as I said, clause 13D is whether any adjustment is required to be made to profit or loss for complying with the provisions of ICDS notified under section 145 subsection 2. The answer to this will be either yes or a no. If the answer to this is yes, then you move on to E and quantify the adjustment, that is ICDS number, ICDS name, and increase in profit, decrease in profit, and net. So clause E is where we quantify the ICDS adjustment. Clause F is something which is very, very relevant, disclosure as per ICDS. Now let me tell you one thing. Irrespective of what is your answer to clause D and clause E, if you are filing a tax audit report, clause 13F will always be applicable to all the assessees following mercantile system of accounting. It will always be applicable to, because ICDS is applicable to all assessees following mercantile system of accounting, with an exception of individual and HUF who are not having tax audits. So since we are discussing tax audit, I assume that all our cases which we are discussing will be subject to tax audit. So therefore, clause 13F becomes very, very relevant. I have seen many tax audit reports where the disclosures are not given, and we have just mentioned not applicable in D, E, and F altogether, which I must say is not the correct view or is not the correct practice. So towards the end of this slide deck, what I have done is I have tried to give few sample disclosures of ICDS, which will be helpful, and you can take that as a base, and you can, change the I would say the disclosures with respect to your client requirement and the facts of the client, and I hope that will be useful to you. So I'll be sharing this slide deck after the session. So moving on to clause 31, as I said, now this is in relation to section 269 SS and 269 T. Now here, what is important is the seniors in the profession would be aware that earlier clause 31 we used to report only on an exceptional basis, that is if my loan or advance in cash component is there, I used to report it at that point in time. But now if you see, the reporting requirement is changed, that it requires us to report whether such loan or deposit is taken by check, bank draft, or ECS. Now, as I said earlier, what we used to report, whether it is otherwise by way of account pay check or bank draft, and we used to say no, and we used to close there. But now they want an affirmation from the tax auditor. While you may say that it remains the same, the reporting requirement remains the same, I would have a different opinion here that reporting requirement does not remain the same. In fact, here we as a tax auditor are required to give a positive affirmation or a confirmation that loan or deposit is taken by check, bank draft, and ECS. And if it is by check or bank draft, whether it is accepted by account pay check or account pay bank draft, that has to be reported. So this is one change in relation to 269 SS. Plus another change is in clause 31B, because 269 SS has been amended by Finance Act 2015, and it has now included any sum, specified sum receivable in relation to I would say immovable property, transfer of immovable property. So therefore, any advance received towards transfer of immovable property is also now required to be reported in 269 SS. So therefore, clause 31B has been inserted recently. Manner of payment, clause 31C, this is in relation to reporting for 269T, that is repayment. So again, here also the reporting requirement changes to from negative or comment from negative comment to a positive affirmation, wherein a tax auditor is required to give an affirmation or a confirmation that whether the payment is made by check, bank draft or ECS, and if it is made by check or bank draft, then whether it is by account pay check or account pay bank draft, as the case may be. One thing is important here is that earlier the reporting requirement was only from the perspective of the payer, effectively the borrower. Now assuming I am the borrower, if I am receiving any loan or advance other than by way of cash or other than by way of cross check or bank draft, I used to report as a borrower. Now if you see, similarly 269T also was to be reported by the borrower. But now if you see this reporting requirement, clause 31D, it requires the reporting by the recipient also, that is the lender, the person who is receiving the repayment, the person who is receiving the repayment. So while 269 SS and T are applicable to the borrower, the reporting requirement here for repayment in 269T is to both the parties, that is by the borrower as well as the lender. The purpose of this amendment, if you ask me, or I see it in the manner that if you have as a borrower, if you miss to report, then it is the lender might report, and therefore the department will go on to the cross referencing, and from the tax audit report of the lender they will be able to catch hold of the borrower. So this is the, I would say, the crux of this amendment, that why this amendment has been brought in, to have a cross referencing. Now if you see, the tax authorities are more relying on cross referencing and multiple reporting from not just different SSCs, but from different authorities or different agencies also. We'll see in the subsequent slides the specified financial transactions reporting, that is 285BA, etc., and the cross linking of details from the GST returns, or MOUs being signed with MCAs, MOUs being signed with SEBI, to get information directly from those authorities and agencies. So the department or that income tax authorities are now going more digital and seeking information from the different agencies within the country as well. So this is the changes. Now we move to the changes which effect from 20th of August 2018. Now, as I said, I have broken up these changes into 4 baskets. The first basket is connecting the dots, project insight, SAR, that is special anti-avoidance rules, GAR, that is general anti-avoidance rules, and the last basket is basically transfer pricing and other changes. So if you look at, we'll go through each basket one by one. The very first basket is connecting the dots or project insights. So here, one important aspect is that income tax, now we see we are in the age of, we are hearing much about faceless assessment, faceless appeals, e-assessments, e-appeals, everything going digital as far as income tax is concerned, right? So the faceless is the buzzword as far as the income tax is concerned. Now this has started not recently, but the department or the income tax and CBDT has started this process long back, and they have invested big time in the technology, in the big data mining, data warehousing, etc., and which also gives the auto alert to the tax authorities. And with the SFT reporting, etc., they have been getting information from the other agencies also. So they have built up a tool with a cost of USD 156 million, and it took almost 7 years to develop this entire tool and the entire system. So therefore they are having a 360-degree profiling of the taxpayers using data analytics, attacking multiple fans, cross-referencing, as I said, using the data from the SFT reportings, from banks, post office, ROC filings. Whole of the government approach, that is multi-ministerial task force setup, wherein there is cross-linking between the data between different ministries and the different agencies. Non-filing monetary system or monitoring system, effectively earlier the reporting was limited or restricted to, not all the cases of non-filers were being reported. So what is important here is that now, as soon as the due date crosses, immediately the notices are being issued. The notices are being issued to the non-filers through the system, and everything is almost with minimal manual intervention. Everything is through the system itself. So therefore, this particular aspect is something where we need to cope up with. That department is a step ahead of us in terms of being digital. Now it is our turn to abreast with the change in technology and the change in the way we practice and the change in the way we represent before the tax authorities in the age of the digital era and the faceless era. So the first aspect in relation to this is linking of expense claims with GST. Now, of course, this has been extended to next year, so we need not spend much time on this slide, but still, this will be applicable from next year. So if you see, what is relevant here is that they are linking all our expenses to the GST, and need to they need to check whether GST has been paid on all the expenses, etc. So this is something which will be a tedious task. Assuming I am doing only the tax audit and the corporate audit of the particular client, and GST is being handled by a third party consultant or any other consultant. In that case, even though I'm not handling the GST, next year onwards, I'll be required to go through the GST returns, understand the GST returns, and then do the reporting in clause 44. So look at the task at hand, or I would say the responsibility on the tax auditor, or the onerous responsibility, I would say, doing reconciliation, disclosures, etc., wherein the time involvement or the effort involvement is increasing many folds. Now, if you compare that with the fees which is being received, I am not sure whether the fees is commensurate with the efforts involved in terms of the tax audit reporting. And we'll see more in the upcoming slides also, the additional or the onerous responsibility on the tax auditors and how the efforts are increasing day by day. Reporting of specified financial transactions. As I said, I have been saying this since a while now, that this is where the department has been getting the information through different agencies. So as you are aware that for certain transactions, mentioning of PAN is mandatory. For example, for opening of bank account, PAN is mandatory. For opening of demat account, PAN number is mandatory. If you have to have jewelry of say more than 50,000, if you purchase jewelry of more than 50,000, in that case also PAN is mandatory. So these transactions where PAN is mandatory, if you don't have the PAN, then the vendor is bound to take form number 60 from you, and the vendor is required to take form number 60 from you, and the vendor has to report all these form number 60s in biannual forms in the form 61. So they have to report all these form 60s in form number 61 to the tax authorities twice a year. If you fail to do this, then there is a penalty of 10,000 for non-compliance. Not only this, the ambit of this PAN has been enlarged to include purchase and sales of 2 lakh or more. All the transactions of purchase and sales of 2 lakh. This is how they have expanded the scope of this particular reporting. The next reporting is form number 61A, that is SFT reporting, specified financial transactions reporting. So here also the scope is enlarged from April 2016 to include cash sales of 2 lakh or more, Here the penalty is 200 or rather 500 per day, and it is an ongoing penalty up to the date of compliance. The last is 61B, which is FATCA and CRS reporting. This is specific to the FS or a financial sector, may not be applicable to all the clients, but to only the specific category of clients in the FS sector. Penalty of INR 500 per day. So that is something which is important. 61 and 61A. And as I said, there is an onerous responsibility on the tax auditor to report on the veracity of filing. At the first instance, I as a tax auditor, I need to be aware of applicability of form number 61 and 61A, which many chartered accountants may not be aware of, because it is very easy to report 42 clause 42 as not applicable, but it is relevant for us to understand whether this provision of form number 61 and 61A is applicable to me. Only then proceed for reporting in clause number 42. So therefore, first we'll look at 61 applicability of form number 61. So step one, you need to check the transactions. As tax auditor, you need to check the transactions, whether the PAN is required to be obtained and whether it is correctly verified. So few examples of applicability of PAN is basically banks, authorities and institutions, etc. As I just discussed, opening of bank account or demat account, purchase of mutual fund, forex or RBI bonds of 50,000 or more, cash deposits of 50,000 or more, purchase and sale of immovable property of 10 lakhs or more, hotels and restaurants cash receipts of 50,000 or more. In case of corporates or companies, issuance of bond or debts of 50,000 or more, sale or purchase of shares of 1 lakh per transaction. It is 1 lakh per transaction. Any person, sale or purchase of goods or services of rupees 2 lakh per transaction, of rupees 2 lakh per transaction. So these are the cases where PAN number is mandatory. So here, if you have not provided PAN, then you will have to provide form number 60. And these agencies, that is the banks, authorities, institution, hotel company, any other person as the case may be, will report all these form 60s in biannual return in the form number 61. As auditor, first of all, you need to check whether this applicability is there to obtain PAN. If yes, whether the PAN has been obtained properly. If the PAN is not obtained, whether form 60 is obtained. And once form 60 is obtained, whether the form 60 has been reported properly in form number 61. So effectively, you need to do a deep dive of all the transactions on the applicability of this particular clause and then go for the verification process. Report in clause number 42 of the tax audit report that all PANs have been correctly obtained and verified. Form number 60 is obtained in case where PAN is not available or verified. All non-PAN cases have been reported in form number 61. So as I said, the responsibility is increasing. It is an onerous responsibility to report all the transactions where PAN is there and PAN is not there. You need to check whether form 60 is obtained and whether form 61 is filed or not. Next is 61A, that is SFT reporting. Again, we'll quickly go through the applicability. Banks, authorities or institutions having cash deposits of INR 10 lakhs in current account and 50 lakhs in the current in non-current account 10 lakhs and in current account of 50 lakhs or more. Cash withdrawal of INR 50 lakhs from current account, fixed deposit of 10 lakhs, credit card payment of 1 lakh in cash or 10 lakh through other modes. Immovable property purchased of INR 30 lakhs or more. So if you see here, earlier slide had immovable property of 10 lakhs and here we have 30 lakhs. So if we are talking about our jurisdiction, that is Mumbai, even if we go in the interiors of the suburban, say Vasai Virar also, and one has to purchase a 1 BHK flat, it easily will cross 30 lakhs. So therefore, all the immovable property transactions will be reported by the sub-registrar under the SFT reporting under section 285 BA, and therefore they have to report all these transactions, and this is how the income tax authorities come to know about the purchase of the property or the sale of the property as the case may be. So again here same thing, PAN is mandatory and the reporting of non-obtaining of PAN you need to take form 60 etc. So this is how you have to report for SFT transactions. Now ICI has also come up with the implementation guide for this particular aspect, and they have given some guidance on how do we go about auditing or verifying these details in form number 61 and 61A. So 61 talks about the guidance says to verify whether the assessee has entered into any transaction, whether the other party was required to give PAN but gave form 60. Assessee need to file form number 61. Details to be given about filing of form number 61. So all this is something which the auditor needs to check. SFT reporting, as I said, you need to check applicability of section 285 BA, read with rule 114E. So if you look at rule 114E, it gives you the list of transactions and the amount limit for each transaction for applicability of SFT, that is 285 BA reporting, that is form number 61A. It also applies to issue of bonds, shares and buyback of shares for listed companies. This is not a regular transaction, so therefore you need to give proper attention, is what ICI guidance says. Receipt of cash payment above 2 lakhs by all assessees under tax audit. This is important. Receipt of cash payment of 2 lakhs by all assessees under tax audit. This is different from 269 ST. Now in the subsequent slides, we'll also cover 269 ST, that is the cash receipts. But here we are talking about receipt of cash payment above 2 lakhs by all the assessees under tax audit. So this is something which is required in SFT also. And this is different. 269 ST, if you see, it says payment for different transactions is not covered in that particular case. It covers only payment from one person. But here 269 ST is narrower, but SFT reporting is wider. It covers payment from different transaction on different dates is also covered here. So you need to look at on a consolidated basis as far as SFT reporting is concerned. Guidance in relation to form number 61B. This is again in relation to FATCA and CRS. Tax auditor should review the due diligence procedure and look at the press release issued in November 2016. Review list of reportable accounts identified by due diligence process and information to be maintained and reported. Then moving on to the next aspect of TDS reporting, that is clause 34B. This is something again a typical thing where the tax auditor is required to enter the shoes of the tax officer or the TDS officer. Now, if you look at the last column here, what was required to be reported earlier, whether the statement of tax deducted or collected contains information about all details or transactions which are required to be reported. Earlier, the reporting was restricted to this. Now, they are also asking us to report. If not, please furnish the list of details or transactions which are not reported. So here, effectively, you need to verify whether the tax has been deducted at source properly and has been deposited correctly. That is one. If it has not been deducted, then you need to verify those transactions, furnish the list of those transactions and details of those transactions and the reason why they are not reported. So therefore, as I said, you are entering the shoes of the tax officer. You are going into the investigation mode and not an audit mode. So that you need to check if in the cases where tax is not deducted, whether 197 has been obtained, whether 195 order has been obtained, nil withholding order is there, or if a particular position is taken for non deduction of tax at source, then on what basis that particular decision has been taken, on what basis you have taken that particular position. Everything has to be verified by a tax auditor. And for a reporting in one particular clause 34B, I would say depending on the volume of the transaction, it will take hours, not only hours, but days together to verify all these aspects of the TDS returns, etc. And it is quite possible that client has taken particular position, for example, purchase of software from overseas, right? A simple transaction of purchase of software from overseas, and the assessee has taken a position that TDS is not applicable because this is a shrink wrap software or off-the-shelf software. So therefore, TDS is not applicable. Now, this is a case which is debatable, and software payments have always been subject to litigation. The matter is pending with the Supreme Court on applicability of TDS on software and taxability of software. So therefore, it has always been litigative whether the tax authorities have been clear that TDS is applicable on software payments, whereas the view of the assessees is that it is only the customized software which attracts the TDS. Otherwise, shrink wrap software is nothing but purchase of software and purchase of goods, and it should not attract TDS. So this is something which litigation is going on since years, and therefore this is one example. There may be many other cases where you are applying make available clause for making payment to non-residents, etc., and not deducting tax at source. In fact, for domestic payments also, for standard payments, standard services, we don't deduct tax at source under section 194J. So all these are things which are subject to interpretation, and you need to go for, you need to verify all those interpretation and report accordingly in the respective clause. So here the guidance of institute says that the auditor should take into consideration the relevant section, rules, notifications, circulars and various judicial pronouncement in relation to the transactions of relevant payment or collection. If the tax auditor does not agree with the interpretation, this is what I am saying. If there is difference in interpretation, assessee is interpreting in one way and you are interpreting in another way, then you have to report your views in clause 3 of 3CA or clause 5 of 3CB as the case may be. SAR, special anti-avoidance rules. Now, one thing in relation to the implementation guide is that the ICI has also come up in as late as last week of October. It has come up with a checklist on tax audit report, a detailed checklist on what documentation is to be maintained by the tax auditor, so that you are in compliance with the standard on audit 700 for for conducting the tax audit. So it will be relevant for you to refer to that, and it has various examples and various specimen for documentation requirement, etc., and reporting requirement. So you would I'm sure you might be aware of that particular document, and ICA has already uploaded the document and it is available for download. You can refer that document before finalizing the tax audit reports and have the checks and balances in place, so that once we have that in place on a year-to-year basis, it will be on an autopilot mode, and we have the checklist of documents in one place, so that we are not missing out on anything. So moving on to the next aspect of SAR, the first reporting requirement is for deemed dividend 222E clause 36A. Now here, what is important is, first of all, what do you mean by deemed dividend? What is the basis of taxation of deemed dividend? And then we come to the reporting requirement in clause 36A. So deemed dividend, the basis of taxation is given in section 222E. Loan or advance to a shareholder by a closely held company is deemed to be taxable as dividend to the extent of accumulated profit. To the extent of accumulated profit, it is taxable on payment basis even though the accounts are maintained on mercantile system. Now taxability is only to the extent of accumulated profit. That is important. Now, levy of deemed dividend, levy of tax on deemed dividend. Now, earlier, just to go back in history, deemed dividend in section 222 we never triggered dividend distribution tax under section 115O. The 115O is introduced for deemed dividend only in financial year 17-18 onwards. So therefore, from financial year 17-18 till financial year 20, because now from 2021 onwards, the dividend is again taxable in the hands of the shareholders, which was not the case earlier. Earlier, DDT was applicable till March 31st, 2020. DDT is applicable, and in this case, 222E, the tax rate for DDT is 30%. The tax rate of DDT is 30%. Now, why 30% is basically, this provision is an anti-abuse provision. 222E is an anti-abuse provision which is introduced to curb the practices of companies, rather than giving dividend, giving loans and advances to their shareholders, so as to overcome the taxability of dividend. So therefore, while 222E was there, practically there were very few collections of tax in relation to 222E. Nobody bothered to pay tax on deemed dividend under 222E. So therefore, the onus has been shifted from 17-18 till, of course, 31st March 2020 on the company giving loan or advance, and the DDT is applicable at the rate of 30%. And if you see, the DDT on normal dividend is 20%. So effectively, the idea is nobody will want to pay 30% tax, rather they will simply pay dividend and pay 20% tax and close there and there. So effectively, this rate is higher than the normal DDT in order to curb the practices of this giving loan or advance to the shareholders. Now, looking the entire ambit of deemed dividend, it is applicable to closely held companies, no distinction between Indian or foreign companies. Nature of receipt, payment in the nature of loan or advances, payment in the nature of loan or advances. Exception, the payer is in the money lending business and amount set off against the previous year deemed dividend. So if any dividend tax has been paid or on deemed dividend, then ultimately it will be set off when actual dividend is paid. Person covered is important. Any shareholder with 10% or more beneficial ownership, and or rather or. So the first leg is any shareholder with 10% or more beneficial ownership. The second leg is any concern in which that shareholder is a member or partner and has substantial interest of 20% or more. So here we are talking about a firm, for example, partnership firm, where such shareholder means who holds 10% or more in the company, in the private limited company, and he also holds 20% or more substantial interest in that partnership firm, and the loan is given by the company to that partnership firm. In that case also, deemed dividend will get triggered in 222E. Quantum of dividend, it will be only to the extent of accumulated profit. which is as per books of account. If the company is into losses and there is no accumulated profit, 222E will not get triggered. Timing of taxability, as I said, it will be taxable on payment basis. As and when you receive the loan, it will be taxable and the company will be liable to pay DDT. Now I have taken three examples, three scenarios of applicability. I'm not sure whether chat box is available to you, but I would want your suggestions or your inputs on applicability on scenario number 3. I will discuss scenario 1 and 2, which is fairly straightforward. So scenario 1 is basically ICO is a shareholder holding 20% shareholding in ESCO 1, and the loan is given by ESCO 1 to ICO shareholder who is holding more than 10%. In this case, he is holding 20%. So effectively, he falls in the first leg itself. So therefore, 222E gets triggered in this case. And ESCO 1 will be liable to pay the dividend distribution tax. Scenario 2, ICO is the shareholder holding 20% each in ESCO 1 and ESCO 2. So now if you look at the applicability, ESCO 1 is giving loan to ESCO 2, right? So you fall in the second category. You fall in the second category wherein you need to check whether ICO is holding more than 10% in ESCO 1. The answer is yes. Now you need to look at the second condition, whether ICO is holding more than 20% or more in ESCO 2. The answer is yes, it is holding exactly 20%. So therefore, loan by ESCO 1 to ESCO 2 will fall in the ambit of 222E, and thereby it will be taxable, and therefore DDT will be required to be paid at the rate of 30% by ESCO 1. Coming to scenario 3, if you can use the chat box and answer whether scenario 3 will trigger, I would say, the applicability of DDT. So ICO 1 is the shareholder holding 20% in ESCO 1, and ESCO 1 is holding 20% in ESCO 2. Loan is given by ESCO 2 to ICO. Loan is given by ESCO 2 to ICO. Now here, I would want your inputs whether 222E will get triggered in this case or no. You can use the chat box. And the organizers can please help me with the answers if they get any. Whether 222E will get triggered in this case or no. Any answers in the chat box?
Anuj?
No. So the chat box has been disabled. So
okay, it has been disabled. Or not an issue. So I will only have to answer this. So here, effectively, if you see, ICO is holding 20% in ESCO 1. It is not holding anything directly in ESCO 2. Whereas ESCO 1 is holding in ESCO 2. Okay. So here what we need to see is what is the indirect holding of ICO in ESCO 2. ICO is holding 20% in ESCO 1 and ESCO 1 is holding 20% in ESCO 2. So effectively if I compound 20% of 20% comes to 4%. So the first conclusion is ICO is not holding anything in ESCO 2 directly, but it is holding 4% indirectly in ESCO 2. It is holding 4% indirectly in ESCO 2. And the loan is given by ESCO 2 to ICO, which is holding only 4%, which is less than 10%. So effectively, 222E will not get triggered in this scenario. 222E will not get triggered in this particular scenario. Okay. Now moving on. What do you mean by deemed dividend and when it will trigger? When do you say that it is loan and advance? So there are few case laws which I would like to discuss here, wherein the courts have held whether it will be deemed dividend or whether it will be loan and advance or not. So shareholder doing business with the company always having debit balance. Always having debit balance. In that case, CIT versus Jamna Das Khimji Kothari, 92 ITR 105. The Bombay High Court has held that this particular transaction, since it is only with the shareholder and always having a debit balance, it will be a loan and advance and 222E will get triggered. Then loan by a lending company only to the shareholders also as deemed dividend. So loan by a lending company giving loan only to the shareholder So we have just seen earlier in the earlier slide that in case of a lending company or company in the business of lending, the 222E will not get triggered. However, if you just form a company for the purpose of lending and borrowing and you lend only to your shareholder, it means you are trying to circumvent the provisions of the law and trying to prove the loophole. So therefore, or trying to use the loophole. So there also the courts have held that this also will be considered to be deemed dividend. Loan given does not cease to be deemed dividend if there is a subsequent repayment. So even if the loan is repaid in the same year, does not mean that 222E will not get triggered. 222E will get triggered. However, in the subsequent year, when there is a actual dividend payout, to the extent of deemed dividend, which has already been considered, it will be set off against the actual dividend paid later on, so that there is no double taxation. And now coming to the cases where the courts have held the payments not to be loans and advance, trade advance, that is a normal advance given for adjustment against job work charges and to install plant and machinery, etc. These are normal commercial transaction at arm's length, of course. In these cases, the courts have held it not to be loans and advances. Intercompany deposit, ICDs, between two group companies is held to be trade advance. So therefore, this will not be considered as loans and advance. Advance is received as security deposit. Against actual services. So here also, if it is against actual services, EMD, etc., then it will not be considered as loans and advance. This is what various courts have held. Effectively, if you look at the entire ambit of 222E, we saw 3 examples, but take a case where there are multiple group companies, multiple entities, multiple partnership firms and companies within the group. It is very, very difficult for us to understand the transactions within the group and thereby determine whether 222 is applicable or not. So therefore, it is difficult and evaluation has to be made on the facts and circumstances of each case. And you need to be aware of the entire group chart, entire group presence, so as to understand the applicability of 222E. What do you mean by accumulated profit? In simple terms, accumulated profits is nothing but the profit from which the dividends can be declared. That is, it covers general reserve and also it includes bonus shares issued out of reserves and surplus. So here also evaluation is to be made on the facts and circumstances of each case. You cannot have a thumb rule. You need to evaluate each case based on the facts and figures. Key action points for the tax auditor: you need to examine details of all loans received from group companies, evaluate the accumulated profit of the lender entity. Reliance will have to be placed on interim financial statements up to the date of distribution. So if the distribution is made in between the years, say for example 1st September, 1st October, then you have to prepare the financials till that date and have a pro rata basis. I would say the profit will have to be distributed on a pro rata basis up to that date to arrive at the interim financial statement and to arrive at the accumulated profit till that date. Then in relation to various transfer pricing adjustments also, where whether deemed dividend will apply is another issue, which is specific to non-resident SSCs or international transactions, secondary adjustments, etc. So those are different issues having nitty-gritties with respect to the TP cases, the transfer pricing cases. Implementation guide says that auditor has to obtain a certificate from the assessee containing list of closely held companies where the assessee is beneficial owner of shares carrying not less than 10% of the voting power. Obtain list of concerns taking loan from the closely held companies. Appropriate remarks in Form 3CA and 3CB about inability to independently verify the information and reliance on certificates, because we may not be in a position to verify the entire group structure and all the transactions considering the paucity of time. Payment made by closely held companies on behalf of the assessee. Difficult to have records. Remarks shall be given in 3CA. If already taxed in the hands of the assessee as perquisite, cannot be taxed again as deemed dividend. So and this is not to be reported also. So effectively there will not be double taxation and therefore no reporting also. Verify 26 says this is not relevant for this year because it is relevant only till AY 18-19. Appropriate remark where beneficial shareholder is not the registered shareholder, because there are various judicial precedents which have held that 222 is triggers only where the beneficial shareholder and registered shareholder are same. So therefore, if I am taking a position that beneficial shareholder is different and registered shareholder is different. So you need to give appropriate reporting, or you need to give appropriate remark in the report. Accumulated profit on the date of transaction may be determined on time with proper appropriate remarks in form 3CA, 3CB. As I said, if it is loan is given on 1st September or 1st October, you need to do it on time basis. Give remarks as regards the decisions relied upon for taking the decision or taking any stand on any legal issue. So if you are relying on any judicial precedent or judgment, give remarks and include those judicial precedent for taking any position. So deemed dividend effectively from AY 1920 and 2021, only for these 2 years this will be relevant. That Finance Act has amended and included 1150, that is dividend distribution tax for DDT or for deemed dividend also to 22E at the rate of 30%. Such dividend will be exempt in the hands of the recipient under section 1034. Now whether clause 36A will be relevant, because again this is again for these 2 years only. Next year onwards again the situation will change, because now the dividend is taxable in the hands of the shareholders going forward. So effectively, if you see, the reporting is in the hands of the shareholders. The reporting in 36A is in the hands of the shareholders. But if you see, the payment or the liability is in the hands of the payer company, right? So since the liability is of the payer company, in this case, the reporting is in the hands of the recipient company. Liability किसी और का है, reporting requirement किसी और का है. So therefore, this is something which is interesting. Maybe again, they want to rely on cross-referencing and thereby catch hold of the assessees. Then moving on, 5629, forfeiture of money received at advance for transfer of capital asset. Now, to give you a simple example, if there is a capital asset, for example, immovable property, and I decided to sell that immovable property, I found one buyer, prospective buyer, and I took the token money from the buyer. Say I took the token money of say 5 lakh rupees. Okay. And in between, suppose this transaction took place somewhere in January 2020. And ultimately, after February, we have the corona and the pandemic and the lockdown, etc. So there is no visibility in terms of the financial transactions or financial, viability of anybody. So therefore, practically it may happen that the person wants to cancel the deal, because either there is a loss in his business or his salary is being cut down, whatever. So he wants to cancel this deal. Now, as per the original agreement for sale or original, MOU, I am eligible to forfeit this amount. So ये जो 5 लाख रुपया है, उसमें से I forfeit 4 lakh and I refund 1 lakh rupee, assuming. So I have forfeited 4 lakh or I have forfeited 1 lakh, whichever is the amount. Earlier, what used to happen is this forfeiture amount used to be reduced. From the cost of acquisition while calculating the capital gains. But from financial year 14-15, that is assessment year 15-16 onwards, this forfeited amount is taxable as income from other sources under section 5629. So now, since this is taxable as income from other sources and not to be reduced from my cost of acquisition, this forfeiture amount will have to be offered to tax as income from other sources. Therefore, this is the reporting requirement in clause 29A to report such transactions of forfeiture. Now, what is relevant here is it is in relation to capital asset and not stock in trade, right? Because if it is a stock in trade, it will be taxable as income from business and profession under section 28 and not under section 56 as income from other sources. So this is very, very relevant to understand that it is only in relation to capital asset. So what is important here is how do we detect whether the amount has been forfeited in absence of any accounting entry. So practically it will be difficult for auditor to verify unless there is any accounting entry being passed for the forfeiture, because पैसा तो already मेरे पास है, पैसा अगर मेरे पास already है and I am forfeiting it, unless I pass an entry in my books of accounts, the auditor will not come to know that the amount has been forfeited. Or unless there is any documentation about forfeiture, the auditor will not come to know that there is a forfeiture. Implementation guide क्या बोलता है? It says no reporting required for forfeited amount in respect of a personal capital asset where no entries are recorded in the books of account. For example, if I am a practicing chartered accountant, and this particular property which I am talking about, is in relation to my personal property, my residential flat, for example, which I have not recorded in my books of accounts, right? Which I have not recorded in my professional books of account because that is my personal asset. Then in that case, ICI says you need not report those transactions because that is a personal capital asset. Reporting required only if advance is outstanding for a considerable period of time. No reporting unless it is forfeited by an act of the assessee. It should be a positive act. No reporting required for forfeiture of the amount in respect of stock in trade, as I said, because it will get covered in 28(1), that is business income. There should be a right to forfeiture as per the contract. ठीक है, आप blindly forfeit नहीं कर सकते हो. There has to be a right in the contract to forfeit. Mere notice of forfeiture contested by the other party will not amount to forfeiture. ठीक है, सिर्फ notice देने से नहीं चलेगा. It has to be a positive act of forfeiture. If not written back by the assessee, not to report, giving the stand of the assessee. If it is not written back, then I may not report it, and I will give the stand of the assessee that there is a forfeiture, but it is not written back yet, subject to certain conditions and contingencies. Therefore, we are not reporting it. Next, where contingencies that permit forfeiture has occurred, but yet the assessee contends that the amount is not forfeited by it, then the auditor shall look at the totality of the developments and may obtain an MR. For example, my condition was that you have to register the agreement within a period of 2 months. So when I entered in January, I had mentioned in the particular MOU that this agreement for sale has to be registered before 31st of March. If you don't register before 31st of March, I will cancel the deal and I will forfeit. Okay? Now the 31st March date has gone, but we all know that practical difficulties are being faced by many people, and the real estate sector is also down, whatever, etc., blah blah blah. So therefore, I am not cancelling the deal, even though the contingency has triggered. But still, I am not cancelling the deal, and I am still giving the chance to the person to continue with the deal. So this contingency though has occurred, I am not going ahead with the forfeiture. So looking at the totality of the development, I may obtain an MR and report accordingly in my 3CD. Unilateral write back of the amount without any contractual right may not amount to forfeiture. So just write back will not amount to forfeiture. There has to be a contractual right for the forfeiture. Okay, unless there is a contractual right, I don't have any right to forfeit that particular amount. Then write back without forfeiture, generally unlikely. That is, I am crediting it to my P&L account, but I am not forfeiting it. Practically, this may not happen, but still, if it is happening, then auditor should be cautious and using professional judgment. 56(2)(10), that is clause 29B, gift tax. Now, most of you might be aware that there were a couple of sections earlier, 56(2)(7)A and 56(2)(7)B for gift tax and deemed taxability. Now, both of these sections have been subsumed into one section, that is section 56(2)(10). So corresponding reporting is in clause 29B. So this is in relation to gift or receipt of sum of money or property without any consideration or inadequate consideration in excess of 50,000. Now the property includes money, it includes movable property, it includes immovable property also. In respect of immovable property, there was a relaxation of 5% earlier. Now that relaxation has been increased to 10%. So if the gap between the stamp duty value, now here what is to be taxed is fair market value and actual consideration. The difference between fair market value and actual consideration is taxed as income from other sources. So here what is relevant is, if my fair market value, that is in case of immovable property, stamp duty value will become the fair market value. So this fair market value, which is say the difference between the fair market value or the stamp duty value and the sale consideration, if the difference is say less than 10%, if the difference is less than 10%, assuming my stamp duty value is 110 and my actual consideration is 100, then in that case 56(2)(10) will not get triggered because of this relaxation, and I will still continue to offer my actual sale consideration to tax as full value of consideration, and there will be no taxability as other sources in 56(2)(10) also in the hands of the recipient. So here this is one aspect to be considered. Fair market value will be determined as per rule 11 UA. So as I said, stamp duty value for immovable property, market value for jewelry, arts, etc., and net asset over the other assets. This is what you need to calculate as per rule 11 UA. food for thought. One important aspect is there can be double taxation, because for transfer of shares there is, from the perspective of the transferor or seller, there is a particular section called 50CA, which again boils down to rule 11 UA, and from the perspective of the recipient we have 56(2)(10). So there can be a situation of double taxation, of course, in the hands of the two persons, not in the hand of the same person. That is, 50CA will trigger in the hands of the seller and 56(2)(10) will get triggered in the hands of the recipient. It is quite possible. So now this is relevant for reporting also 56(2)(10) in clause 29B. Now look at different cases where 29B, whether it will get triggered or not get triggered. I have taken few examples, issues for consideration. Whether fresh issue of shares will be covered. There is a decision in the case of 56(2)(7)(a), wherein the Supreme Court has held that allotment of shares in appropriation out of unappropriated share capital does not amount to transfer. Now this judgment talks about transfer, right? But if you look at the wording of section 56(2)(10), it says receives. It says receives. 56(2)(7)(a) में transfer हुआ करता था, but 56(2)(10) में the wording is transfer, or rather receives. So we had this discussion with senior advocate Percy Patiwala also, and Percy also is of the opinion that 56(2)(10), since the wording is received, it is wide enough, and Kodai distillers will not be applicable going forward on fresh issue of shares, and fresh issue may also get triggered. 56(2)(10) may also get triggered in case of fresh issue, and it will be taxable if the consideration paid is less than the fair market value or the 11 UA value, as the case may be. Whether issue of bonus shares will be covered. So bonus is nothing but it is without payment, but it is not without consideration. Effectively, my own value is getting converted into shares. My own net worth is getting converted into shares. So Supreme Court in the case of Dalmia investment has held that issue of bonus shares will not be considered to be taxable as income from other sources. So 56(2)(10) should not get triggered in case of bonus shares also. What about right shares? Right shares is issuance of share at a reduced price to existing shareholders. So here there is a Mumbai tribunal in the case of Sudhir Menon, which says that if there is a proportionate allotment, to all the shareholders, then arguably or the tribunal said that it is 56(2)(10) will not get triggered. However, if there is a disproportionate allotment, that is, allotment is given only to few shareholders, in that case this judgment may not be of help, and thereby 56(2)(10) can get triggered in these cases. Whether buyback of shares at less than fair market value is covered, that is buyback. So for buyback also we have Mumbai tribunal, that is Vora Financial Services, wherein the tribunal has held that buyback will not the buyback shares will not trigger 56(2)(10) because own shares cannot become the property of the recipient company. Other issues for 56(2)(10) is basically chain holding. Now to give you an example of chain holding, for example, I am receiving shares of A Limited. I am receiving shares of A company, A Private Limited. Now A Private Limited holds in B Private Limited, and B Private Limited also holds in C Private Limited. So this is called a chain holding. A holding in B, B holding in C. So if I have to do 56(2)(10) or 11 UA valuation for A Limited, I need to do the valuation of B first. Similarly, if I have to do valuation of B, I have to do the valuation of C first, right? So therefore, I will start with C. I will take the value of C in B, and then I will calculate the value of B considering the value of C, and I will include the value of B while making the calculation for valuation of shares of A. That is an example of chain holding. Multiple holding, A Limited, same case, I am transferring or I am receiving shares of A. A is holding shares of B and A is holding shares of C. This is called as multiple holding. So I have to do valuation of B and C first, and then I will do valuation of A to include the value of B and C. Cross holding, example is A holding in B and B holding in A. So if that is the case, A holding in B and B holding in A, effectively this will give me a circular reference, because if I have to do valuation of A, I need to get the value of B first. Similarly, if I have to do value of B, or valuation of B, I need to get the value of A first. So I will never be able to get any value under 11 UA for cross holding. So the bottom line here is cross holding, the 11 UA valuation fails. 11 UA valuation fails for cross holding. What does the implementation guide say in this regard? The tax auditor should obtain a certificate from the assessee regarding such receipts during the year, either received in his business or profession or recorded in his books of account. Receipts in personal account are not to be which are not recorded in the books of account, suggestively out of the purview of reporting. So as I said earlier also, it is only in relation to the business assets, etc., that you need to report in 56(2), 10 and 29B respectively. If there is a valuation dispute, you need to mention the value adopted by the stamp duty authorities and the value claimed by the assessee to be the correct value. Now, of course, we may not be expert in terms of valuation. We may not be expert in terms of valuation. So therefore, we may advise this matter to the registered valuer, and we may obtain a valuation report from an independent registered valuer to safeguard our interest. Next, 269 ST, cash transactions. Now 269 ST has been recently introduced again from 2017 to have to say that there cannot be any cash receipts of more than 2 lakhs. If I receive any cash, if I have any cash receipts of more than 2 lakhs, more than or equal to 2 lakhs from one person in a day, or from one event, or from one transaction, it is applicable to all individual and businesses. And if I receive this, there is a penalty equal to the amount of cash received. So if I am receiving 2 lakh, the penalty will be 2 lakh. If I am receiving 3 lakh, penalty will be 3 lakh. Restrictions apply to all items, that is revenue or capital, taxable or not taxable, does not matter. Now take few examples. I have taken 3 examples here to cover the applicability of 269 ST. First example is 4.5 lakh sale through 3 different invoices to same person on the same day. This will fall in the first category, that is 2 lakh from one person in a day. 2 lakh from one person, more than 2 lakh from one person in a day. Though there are 3 different invoices, but on the same day, same person. So 269 ST will get triggered. 4 lakh in one invoice, but receipt of 2 lakhs on 2 different days. So it says 2 lakh or more, 2 lakh or more. So exact 2 lakh will also get covered here. Even if it is on 2 different days, it is in relation to one event or one transaction. It is in relation to one transaction and same person. So therefore, it will be 269 ST will get triggered in this case also. Rupees 1 lakh each for 3 different services. Rupees 1 lakh each for 3 different services from the same person. So if this is from same person and received on the same day, then arguably 269 ST will get triggered. But if it is 1 lakh on day 1, 1 lakh on day 2 and 1 lakh on day 3, arguably 269 ST will not get triggered in that case, and thereby it may not be reportable in 31BA to 31BD. What is the disclosure requirement in 31BA to BD? It is name and address and PAN number, nature and amount of transaction, and date of payment. So 269 ST, it covers only receipt, that is, it is from the perspective of recipient. If you look at the reporting requirement in 31BA to BD, it covers both payer as well as payee. So as I said, cross-referencing, reporting is to be done by both payer as well as payee. What happens to transactions by journal entries? There are certain cases, Bombay High Court, Delhi High Court, Gujarat High Court, which says that journal entries may not trigger in cash transactions. So therefore, implementation guide also says that such adjustments are not receipt or payment, and therefore 269 ST will not get triggered, and therefore it need not be reported. Government and government companies, if you look at the Form 31 or Form 3CD and the note below Form 31 or Clause 31, the language suggests that payment to government and government company is not to be reported. So not only government payments, but government company payments also are excluded from reporting in 31 in Clause 31 BA to BD. No difference between revenue and capital. So for clauses BB to BD, BBD and BD, as we report in Clause 31 BA, that is 269 SS and ST, similar note can be put here also, that it is not possible for me it is not possible for me or us to verify whether loan or deposit have been taken or accepted otherwise than by way of account payee check or account payee bank draft, as necessary evidence is not in possession of the assessee. So we can use this note or caveat to safeguard our interest. Information to be retained in working paper. As I said, working paper is the crux, not only for this reporting but for all reporting. And apart from this implementation guide, I repeat, there is additional checklist being issued by ICI in the last week of October for the tax audit. So moving on to GAR. Now GAR reporting is also postponed to the next year. So this is not relevant to this year, but it will be applicable from next year onwards. So maybe we'll discuss this sometime later. But this is also an onerous responsibility, getting into the shoes of the tax officer and determining whether GAR is applicable to a particular transaction or not, and thereby reporting in clause 30C. So other changes in tax audit report, there are 3 more changes with effect from August to 2018. First is the additional reporting in terms of payment to railways. So railways is also covered under section 43B now. Then additional reporting requirement for deduction claimed under 3280, that is accelerated depreciation or additional depreciation under investment allowance, that is 15%. Reporting requirement under clause for 3280. Next one is 269 SS&T. There was one clerical error in the form in clause 31. Repayment was used instead of taken or accepted for 269 SS reporting, which has now been rectified, which has now been correctly rectified. So transfer pricing and other provisions, I'm not sure whether it is applicable to most of us here, but I'll quickly touch upon this. Thin capitalization is a recent amendment under the Income Tax Act, that if you are making interest payments to associated enterprise overseas, that is associated enterprise group companies overseas, then your interest payment cannot exceed 30% of your EBITDA. Your interest payment cannot exceed 30% of your EBITDA. So there is a corresponding information required in form number 3CD. Clause 30B says the disclosure in TAR whether the expenditure by way of interest or similar nature incurred, amount of expenditure by way of interest or similar nature, EBITDA during the previous year. EBITDA is nothing but earning before interest, tax and depreciation. Expenditure by way of interest or similar nature incurred as exceeds 30% of EBITDA.
તમારું શેર સ્ક્રીન બંધ થઈ ગયું વ્યોમેશભાઈ.
હવે દેખાય છે?
Yes, yes.
Yeah, okay, thank you. So and brought forward or carry forward interest expense which could not be deducted. So this is something which you are required to report in clause 30B. Again, this is in relation to transfer pricing adjustments, that is thin capitalization rules, may not be applicable to all the assessees. So key considerations, computation of or allowability of EBITDA, industries with high leverage, infrastructure, NBFCs, real estate sector, it will have an additional burden because their borrowing cost is high and there is a high gestation period also. So quite possibly that my EBITDA will come after 5 to 7 years of construction period. Till then I will be continuing to incur the interest, but there is no relief as of now. Interest to AE though meets the arm's length standard but exceeds threshold of 30% of EBITDA will be chargeable to tax here, or the thin capitalization will trigger here. Applicability to Indian branches of foreign banks or guarantees by AE. AE guarantee implicit and explicit, whether partial guarantee say 60%. So these are all practical aspects to be considered as and when we come across such situations. So ICI implementation guide also says what do you mean by expenditure or similar nature, whether it also includes discount or premium, etc. So this is the guidance note given, or implementation guide given by the ICI also. I think I'll circulate these slides and you can go through it later on. Considering the interest of the time, I think we may continue and go on. Next is in relation to secondary adjustment. Again, a transfer pricing adjustment related reporting in clause 30A, wherein if there is a primary adjustment either suo moto or by the tax officer, then effectively you need to get that amount back from the AE. If you don't get that amount back, then there will be deemed interest. So that also will have to be reported in clause 30A by way of secondary adjustments. So again, we may just go through these slides later on. These are self-explanatory and relevant only from transfer pricing perspective. For the sake of completeness, I have included in the slide deck. C by C reporting, again clause 43, country by country reporting for transfer pricing. Reporting is to be given in clause 43. This is in relation to form 3C EAD, form 3C EAC, etc. Changes in relation to ICDS. I come to the last part of my presentation before we move on to the question and answers. And as I said, ICDS is something very, very critical in terms of reporting in tax audit. And we cannot have a not applicable reporting in clause 13F specifically. So we may not go deep into what do you mean by ICDS or income computation and disclosure standard, because ICDS is a topic in itself. But for the sake of general understanding or to give you an overview, I have tried to include the applicability of ICDS. As I said, it is applicable to all assessees following mercantile system of accounting from assessment year 17-18 onwards. And in the subsequent slides, what I have tried to do is I have notified, or I have included all the notified ICDSs and corresponding Ind AS and accounting standards for ease of reference. And this is the disclosure requirement. 13D is something which we already saw. 13E, this is how it is: increase in profit, decrease in profit, and net effect. Now, if you look at 13F, disclosure as per ICDS. ICDS 1, accounting policies, it will be applicable to all the assessees. ICDS 2, valuation of inventories, it will be applicable to all assessees in the trading, manufacturing, and also to service industry to some extent. Construction contract is a specific ICDS and will be applicable only to construction contracts. Revenue recognition again will be applicable to everybody. Tangible fixed assets again applicable to everybody. Government grants is a specific ICDS applicable only where there is government grant. Borrowing cost will be applicable where there is a borrowing cost and a qualifying asset. Provisions, contingent liabilities, contingent asset also will be applicable to all assessees following mercantile system of accounting. So if you see out of the list of 8, right, except third one, that is ICDS 3 and ICDS 7 on government grants, other 6 are applicable to all the assessees. Other 6 are applicable to all the assessees across sectors. So therefore, this is something which you cannot miss out on reporting in clause 13F. So as I said, I have just quickly captured what are the significant implications of ICDS 1, 2, 3, 4, 5, 6, 7, 8 till 10. Very briefly, you can go through this slide deck. I'm sure you all might be aware of ICDS 1 to 10 somewhere in detail, or at least in brief. So I may not go deep into the applicability aspects. The purpose here is to discuss the 3CD reporting of ICDS, and this is the disclosure requirement for ICDS 1. Then we move to ICDS 2, that is inventories. So this is the disclosure requirement for ICDS 2. 3, construction contracts, disclosure requirement for construction contracts. Revenue recognition, disclosure. Fixed assets, disclosure. ICDS 6 on foreign exchange, one of the most critical ICDSs for foreign exchange transactions. Fortunately, there is no reporting requirement for ICDS 6. 7 is government grants and disclosure requirements. 8 is securities. There is no reporting requirement for securities also. 9 is borrowing cost. This is the formula for a capitalization of general borrowing cost. Disclosure requirement for ICDS 9. ICDS 10, again provision, contingent liabilities, contingent assets, provisions and disclosure in ICDS 10 for clause 13F. Contingent assets. So coming to the key takeaways, and then I move on to the 3CD disclosures for ICDS. So crux of what we just discussed today is linking the expenditure claims with GST, the data integration between government departments, that is income tax and GST. Though this will be applicable from next year, but we need to gear up ourselves for this reporting. Reporting of PAN and financial transactions, that is 61, Form 61 and 61A. SFT, onerous responsibilities casted on tax auditors. Reporting of deemed dividend, as I said, deemed dividend is subjective and contentious issue. So therefore, you need to be mindful of all the transactions between the group and take proper certifications from the client. Abusive practices of gift taxation, that is section 56 to 10, SAR related issues, tax audit to review the valuations. Restriction on cash transactions, that is 269 SS, 269 T and 269 ST. Difficult to verify the voluminous data and reporting thereon. GAR, though it is kept in abeyance, from next year onwards it will be applicable. ThinCap and CBCR, this is specifically for transfer pricing. Now, coming to the sample specimen of 3CD annexures for clause 13F. So this is, I have tried to capture on a generic basis. I'll circulate this slide deck and maybe you can modify this based on the facts of your respective case and you can change the reporting requirement. So for accounting policies, if you have a corporate client where you already have notes to accounts being prepared, so you can give reference to your notes to accounts rather than doing a reproduction of your notes to accounts here in terms of accounting policies. Valuation of inventories, again, I have tried to give standard disclosures. You may modify it as and when required. Construction contract, generally it may not be applicable, so therefore you can write not applicable if your client is not into construction contracts. Revenue recognition, the disclosures. Tangible fixed assets, generally this will be in line with your clause 18. So therefore you can give reference to your tax depreciation schedule as per clause 18 and give reference to the relevant annexure to form 3CD. Government grants may or may not be applicable. If it is applicable, you may modify this reporting. Borrowing cost, again accounting policy, if you have already mentioned that in notes to accounts, you can mention it from there or give reference to that. Amount of borrowing cost capitalized during the previous year, if there is any capitalization as per ICDS 9, mention the amount there. Provisions, contingent liability and contingent assets, again a sample disclosure is given here. So this is for ready reference of all of you, and if you want you can modify this based on the facts of your case. I just thought that this will be helpful for those who do not have any specimen ready with them. I think with that, as I said, that we'll have last 15 odd minutes for question and answers. So with this, I end my presentation and I open the floor for questions and interactions with the participants. Over to you, Anuj and team Matunga CPE.
Thank you, Vyomesh ji.
Yeah.
So participants can use the raise hand facility which is available at the end of the screen, and if they have any questions, we will be happy to unmute them so that they can personally raise the question to the speaker.
Hello. Vyomesh bhai.
Yes, sir.
Jitan here.
Yes, sir.
Acha, now in 20 AS, they are showing this SFT transaction.
Yes.
Right. So now one person has transferred 50 lakh rupees out of India and it is reflecting SFT. Actually, it is a gift from a sister to brother.
Yeah.
So it is in the SFT. So in that case, anything we have to do in this tax audit report?
No, nothing. Since this will be under LRS, right? Liberal.
Yeah.
So as far as tax audit is concerned, this is not to be reported because this seems to be more of a personal transaction.
Okay.
So nothing to be reported in 3CD as such.
Nothing. And we don't have to mention it. Okay.
No, nothing.
Dinesh Acharya ji, I have unmuted you. Please raise your query to the speaker.
Dinesh ji, you can unmute yourself.
Yeah, hello.
Yeah.
Yeah, in case of a cooperative society, a normal which has to file its profit and loss account and all. You see, we are being constantly being asked to file tax audit report because if the turnover exceeds, because I am talking particularly of big commercial societies within Bombay itself. So how does one tackle this issue? Because societies as such are not into business. So per se, there is no business. But we are being asked to file a tax audit report and a notice coming under 139(9) for invalid and all those things. Thank you.
Yeah. So for society specifically, you are not in the business. Basically, they are acting only for the members, and thereby the principle of mutuality comes into picture. And technically speaking, unless it has any specific business activities, etc., or commercial motive, 3CD should not be applicable. Now, what is happening is these notices are being issued through the system. As I said, many notices are being issued through the system. One of the other example where I will see that, where I will discuss that the notices are issued through the system, though technically that amount is not taxable or disallowable, is basically where we have, employee contribution to provident fund, right? Wherein the PF contribution, if there is a delay in making the payment to the PF authorities, we have a Bombay High Court Gadge Patil which says that even if it is paid after the due date, but if it is paid before the due date of return of income, there should not be any disallowance or there should not be any addition to this regard. But if you see adjustments to 143(1), there have been adjustments without considering this, and unnecessary additions are being made. So these particular things are being done through the system or directly, as I said, without any human intervention. Unless there is a modification in the system from the back end, these problems will continue. And though representations have been made to the CBDT and to the income tax authorities to modify their system to this regard, so therefore, this is more of a system issue and needs to be resolved at the IT level of the income tax department. And I think this cooperative issue is also similar. And I'm not sure if this has been represented, but if this is not represented, we should definitely take it up with the tax authorities and the CBDT. And I think this should be modified within the system, and there should not be any such instances in the coming future for this particular thing. We should continue with our stand and reply to 139(9) practically, that we are not in the business and therefore tax audit is not applicable to us. I hope that answers your question, sir.
Yes.
Vyomesh ji, there is a question from Miss Swati, and her question is basically that if there is a professional who is an artist and which is not covered under 44AA, and the profession has incurred losses due to lockdown, and there is a loss which is to be claimed, and this profession is not a specified profession under 44AA, and hence 44ADA should not be applicable. So
Right.
how will the tax audit applicability be determined in this case?
So in this case, the applicability of tax audit will be normal. Effectively, you need to look at the turnover criteria, the normal criteria of 1 crore or 5 crore, as the case may be, and thereby you determine whether you are crossing that threshold limit or no, and thereby and then decide whether tax audit is applicable. Profitability has nothing to do in this particular case because you are out of 4480.
So can it be said that it will be under 44AD?
Yes.
So then we will have to ensure that if there is a loss and it is less than 8%, so then tax audit will be applicable.
4480.
Okay.
Yeah.
Ruchika ji, you can unmute yourself and raise the query.
Hey, going further, in case of Swati's query, can we file a normal net like profit and loss account by choosing, because it's a vocation basically, it's not a business.
Yeah.
And it's not a specified profession.
Yes.
So it will be a vocation, and then we will file just a normal profit and loss account showing whatever. Will that be acceptable? Because her other income is more than the specified, the threshold limit.
Yeah.
So that way, so 44 AD should not apply compulsorily in her case.
Yeah, definitely. So as I said, only if opted for, 44 AD will not directly apply or not mandatorily apply.
Okay. And one more question is, in case of sales of INR 2 lakhs or above,
Hmm.
I was a little confused. Is it necessary that from all the persons to whom such sales are made, the PAN has to be obtained necessarily, whether or not it is been made in cash?
Yeah, for sale or purchase, for sale of more than 2 lakhs, yes, for all the assessees, irrespective of whether it is in cash or no, SFT reporting is required and you need to obtain PAN.
Even though 2 lakhs or more cash has not been obtained from any of them?
Yes, so if you look at the slide, I'll just flash that.
Because there will be hundreds of parties to whom sales will be made of 2 lakhs and more, and then from all of them to obtain, to ensure whether PAN was obtained and putting on the in the SFT list will be a very
No,
difficult task.
if you are talking about taking PAN, then
Uh,
PAN is 2 lakh per transaction, that is for form number 61, right? That is one
huh.
aspect. For form,
But for normal assessees also? Or
yeah.
is it only for banks and all? No.
No, for all the assessees. So there are
Okay.
two aspects here. One, we are talking about obtaining a PAN. So
Huh.
if the sale or purchase of goods or services per transaction exceeds 2 lakh rupees,
Okay.
then in that case you need to obtain the PAN. That is one
Okay.
aspect.
Huh.
The second aspect, we move on to the SFT part. So
Huh.
SFT is only in relation to cash sales.
Okay.
SFT reporting is only for cash sales.
Okay. So as an auditor, we
Yeah.
have to ensure whether our client has obtained the PAN numbers from all the parties to whom he
Yes.
has been making sales of 2 lakhs or more in a year.
Yes.
And then no reporting is to be done. We have to
No
only.
reporting, yes. If you have PAN, no reporting is to be done. If you don't
Huh.
have PAN, then you need to do reporting in form. You need to obtain form 60 and do reporting in form number 61.
Achha, okay. Okay. Okay, thank you.
Yeah.
And in tax audit report, there is no disclosure for this, right? Do we have to disclose somewhere?
Yeah,
In
disclosure
case he
is,
has not obtained form 60.
so disclosure is there in clause 42.
Okay. Okay, thank you very much.
Shashikant ji, please raise your query.
Yeah.
Can you hear me?
Your voice is echoing, sir.
Yeah, you can hear me, na?
Yes. Better.
Hello.
Yeah, go ahead.
Yeah, what I want to know is in case of ICDS reporting,
Yeah.
how to go about reporting impact of Ind AS, unwinding of interest, ROU, depreciation, and lease expenses. How to report that, and where, which clause we have to report? आवाज करो अभी. मेरी आवाज करो अभी.
Yeah. So if you look at Ind AS transactions, so Ind AS is more of an accounting thing. As such, you are not required to report anything with respect to Ind AS. However, I have seen few tax auditors who are going conservative and reporting Ind AS things or Ind AS changes in accounting in ICDS 1. If you see this particular slide, changes in accounting policies, right? So earlier I was following accounting standard, now I am following Ind AS. So these are the Ind AS adjustments. This is where they report the Ind AS adjustments in ICDS 1. While according to me, this is not a change in accounting policy. There is a complete change of accounting standard itself. So as such, even if you don't report in ICDS 1, it is okay. But if at all you want to report, you can report it in ICDS 1, that is change in accounting policies.
Yeah, but all these unwinding of interest, ROU, lease expense, and there will be a host of other
So there will be many,
items which will be added back in the computation.
yeah, there will be
Whether
many.
these will find place in a tax audit report anywhere else?
No, nowhere. Nowhere. It will be only a computation impact, and for example, Ind AS 109, Ind AS 103, all those will form part only of your computation, and as such, no reporting is required in 3CD for Ind AS.
No, one more thing. For example, deemed equity contribution from the parent entity, will it get reflected into the capital receipt, not shown in the P&L?
Sorry, come again.
See, in case of ESOP by the parent entity,
Yeah.
they are issuing shares to the employees, and in under Ind AS we are adding the deemed capital under statement of changes in equity.
Yes.
Will it find place anywhere in the tax audit report?
No, it won't. It won't.
Hello,
No, it won't.
hello.
No reporting required in tax audit. Am I audible?
Yeah, now you are audible.
Yeah.
Yes,
So no
sir.
reporting required in tax audit. Yeah, Anuj, am I audible?
Yes, yes, sir. You are completely audible. So I will unmute Purnima ji, who has next question to be asked. Purnima ji, yes.
Yeah.
Please ask your question.
Similar question, that of ESOP. So just Joshi ji has asked na about ESOP.
Yeah.
Similar question.
Okay. So no reporting is required in relation to ESOP in terms of 3CD.
Okay, no, not in capital items,
No,
capital receipts.
not required. Not required.
Okay, fine, thanks.
Okay. Ajay ji, please unmute yourself.
Hello. Hello.
Yes, Ajay bhai.
Sir, I have one query regarding the ICD.
Yeah.
Whereas I have a valuation difference in the securities valuation of the closing stock.
Yeah.
But in the 3CD, if you see, there is a no that particular ICD has been mentioned.
Yeah, you are talking about valuation of inventories.
Inventory, not inventory, valuation of the securities.
Securities. Yeah. So as far as valuation of security is concerned, there is no disclosure requirement in Form 3CD. You will have to just the impact in clause 13E, the value, the amount impact, and in your computation of income.
Okay, there is no need for give any kind of disclosure for this particular ICD.
13F, the only disclosure will be in clause 13E, the amount disclosure, and in your computation of income.
Okay, only that means only the financial impact I need to give, and not of any other kind.
Yes, sir. Yes.
Okay, sir. Thank you.
Rita ji, you may raise your question next.
Hello.
Yes, Rita madam.
Yeah, I would like to know the applicability for future and options in case of 44 AD, whether 8% is applicable.
For 44 AD.
Yeah, means whether if on the basis of the turnover, so 8% do we have to declare?
No, so for future and option, see, I'll just share one slide, just a second.
Yeah, sure. Thanks.
Yes, so is this slide visible for
Yes, sir.
Yeah, it's visible. It's visible.
Yeah. So here, this is effectively for how do you calculate the turnover. So for speculative transactions, effectively for intraday, you take the net differences from the trades, because as such there is no delivery. For futures and options, you take the sum of both, that is positive as well as negative differences from trades, and also the premium received on sale of options. So effectively, if you have received premium also on sale, that you need to consider, and both positive and negative difference, the sum of both. Delivery based, it is obviously the total value of sales that you consider in turnover and gross receipts. So this is how you calculate the turnover amount for the share market transactions, basically, including futures and options.
Yeah, but then 8% would be applicable. That I would like to know, sir.
See, 44AD will not be applicable in this particular case directly. So therefore, you need not report 8% or 6% as the case may be.
Okay. So on the basis of the turnover, we can decide. So no need to see 8% or 6%, right?
Yes, not
Means
required.
basically 8%.
Yeah.
That's not.
In this case, you may argue 6% because everything is received in my bank.
Yeah, everything is by check only. It's nothing in cash.
So if it is, sir, if it is less than 2 crore, then if it is loss is there, then we have to do tax on it?
Not required.
Not required.
Not
Okay.
required.
But this delivery based equity term you have taken total value of the sales.
Yeah.
So it is, if it is business only, no? If capital gain is there, then is
Yeah, business.
only case of business income.
Yes, business income.
Meeta ma'am, you can unmute yourself and ask your query.
Meeta?
We are not able to hear you, ma'am.
Hello.
Yes.
So,
Yes, Meeta. Hello.
hello. Am I audible?
Yes.
Hello.
Yes, you are. Go
Hello.
ahead.
Meeta, go on. I think Mr. Ketan Negandhi has some question. I think Meeta has disconnected or something. Ketan bhai?
Ketan bhai, I have asked you to unmute. If you can
Ketan
unmute
Negandhi.
yourself.
Ketan Negandhi. Okay, you can ask Meeta and Ruchika madam.
Yes, Yoshika ji, please.
Yeah. So continuing with this futures and options, this is a business income. Futures and options. So if the net, the result of that is a loss, and you have other income more than 2,50,000, will it not be necessary to get the accounts audited? In case of futures and options, in case there is a loss or less than 6%.
So see, as I said, 6% or 6% may not be relevant here unless I have opted for 44AD. So
okay.
In futures and options, because generally what happens is you never know. At times you might have profit, at times you might have loss. So practically, I have seen very few people opting for 44AD in case of FNO, because it may happen in 1 year there is a huge profit and second year there is a huge loss. So therefore, people generally don't opt for 44AD in case of futures and options. So therefore, there I go by the 5 crore turnover limit in this year, because ultimately all these receipts will be in cash, or rather in normal banking channels. So therefore, there is no question of that 5% getting triggered. So this year onwards, the turnover limit will be 5 crores. So unless I breach that 5 crore limit, the audit will not be required.
True, but then there will be many other businesses. This is just a small segment, like out of my.
So I need to look at in totality other businesses also.
Yes.
Yeah.
So, okay.
Meeta.
Yes, Meeta ji.
Yeah. Just taking this future and options thing ahead, I had received a defective notice last year where we had not.
I think we lost your voice.
Yes, we could not, I think. Mitaji, I think you have a maybe a bandwidth problem.
Yeah, it looks like. Maybe we can take this question offline.
Yes.
Yeah.
So I think
So that's what Vyomesh sir, she was telling. Last year I had also received one. It was below that. Then there was loss was there in F&O.
Yeah.
And we had not done the audit. But
Yeah.
that client received a notice that you have not done the tax audit because there is a loss you should have done.
Yeah, so that is many of the clients have received those notices, and therefore we need to reply to those notices saying that again we have not opted for 44AD as the case may be, and therefore if I am not crossing the threshold of the audit applicability, there is no question of audit being done.
Okay.
so. Vyomesh, basically you are saying that 44AD needs to be opted.
Yes.
And it's not a mandatory provision in the first place.
It's not mandatory.
Okay.
You will find views from other seniors that it is mandatory, but according to me, it is not mandatory.
Yes, exactly. Fine. I think with that,
Ketan Negandhi, I think he has raised some question in the mail.
I have asked him to unmute.
Ketan bhai, if you can hear. What he has written is, I can't understand. That's why I'm telling him. Client has done stock lending. He is getting lending fees as some percent of land value. On specific date on market value of shares lended, no TDS is deducted. Besides share trading, F&O short-term shares, and what is turnover for stock lending business for tax audit? I can't. He's asking for whether the stock lending business.
I am not.
Turnover.
What does he mean exactly by stock lending?
I also don't understand.
So maybe Vyomesh, we will get his question in case, and then we may get it to you and get your views.
Yeah, sure.
I think with that we have been able to answer everybody's questions so far appearing in the chat box.
Yeah.
Before moving to the pleasant task of vote of thanks, one announcement with regard to the forthcoming virtual CP meeting of Matunga Study Circle. So we are planning to schedule a virtual CP meeting on 21st November, which is Saturday. The exact timings will be shared with the members. The topic will be, as we are all aware, that Tele 9.0 has been introduced and will be effective from 9th November. So accordingly, we will be the session will be focused on the Tele, the features of the Tele, the transition, and we will be having Jiten Bhai, our governing board member, taking us through the entire features of the Tele, the prime time as it is been described, and we are eagerly waiting to hear him on the on 21st. Sorry for a disturbance. And with this, now I move on to the pleasant task of thanking our speaker of the day. I think Vyomesh ji, you have very well justified the term used by me, a seasoned player, because only he can cover such an exhaustive and such a huge and a vast topic in such concisely and in the given time and with a schedule slotted for also entertaining the Q&A. And therefore, sir, you have, as in I was right, I think at the start when I mentioned that you're a seasoned player. And with this, and I'm sure every members will agree that we have been more knowledgeable and more experienced in the way the issues have been explained to us, and maybe we'll be better able to handle the tax audits which we have. And I think the specimens shared by you will be equally helpful. And with this, I would request every member on the session to thank you, to thank our speaker of the day for sparing his time, his material and his knowledge with everyone, each one of us. Thank you, sir. Thank you, Vyomesh ji.
Thank you, Vyomesh bhai.
Thank you very
Thank
much.
you for sharing your time. Back-to-back meeting you have.
Yes. Thank you, sir.
Okay.